Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Let's break down this short put option quote. Short 1, XYZ Jan 80 put at 7. One of the more important aspects of options is understanding the language associated with them. And by the end of this video, let's make sure we're crystal clear on exactly what this option quote is trying to tell us. First, the word short, which can actually relate to a few different things. Short typically refers to a lack of ownership, or more simply, you can assume that means that the investor sold this option. When an investor goes short an option, they are selling a contract that will obligate them to potentially do something in the future. And that's a key thing to know about options. When an option is sold, it always results in an obligation. We will discuss more about that obligation later in this video. Investors sell option contracts in specific numbers, and there's one in this quote. Every option contract covers 100 shares of stock. Therefore, we can safely assume that this option contract involves 100 shares of XYZ stock. XYZ is a made-up, fictitious company. In the real world, you can find options on many different publicly traded companies, which could include Target, Ford, or Google. If this were a Target option, for example, this option would cover 100 shares of Target stock. Most option questions will involve a fake company just to keep the question fairly general in nature. And that's why you'll see a lot of ABCs and XYZs and PDQs, things like that. Each option will also have an expiration month, which refers to the end of the option. Options typically expire on the third Friday of the month at 11:59 p.m. Therefore, we can safely assume that this option expires on the third Friday in January at 11:59 p.m. Expiration is important because options have something called time value, which we'll discuss later on in this video. This is a put option which provides the right to sell 100 shares of the underlying stock at the strike price. The underlying stock is XYZ and the strike price is $80. For as long as this option is in existence, the option buyer will have the right to sell 100 shares of XYZ stock at $80 per share. But remember, we're not discussing the option buyer with this quote. We're talking about the option seller. The option seller must fulfill the right of the option buyer should they exercise the option. The buyer of this put has the right to sell 100 shares of stock at 80, and therefore the seller of the put will have the obligation to buy those shares at 80 should the option be exercised. The value of an option is always in comparison to the market. If the option provides a better transaction price to the option purchaser versus what the market would offer for that same stock, then the option has something that we call intrinsic value. The option seller is never thrilled about intrinsic value. The more intrinsic value that an option gains usually results in more risk for the option seller and more losses that they eventually will be exposed to. Let's bring this to an extreme to make sure that we understand this concept. Let's assume that XYZ stock drops all the way to $10 per share. Given the fact that the option provides the right to sell stock at 80 to the option buyer, whereas the market price is at 10, there's $70 of intrinsic value there. At this point, there's no question that the option will soon be exercised. And that results in the option seller having to fulfill their obligation. Again, their obligation is to buy stock at the strike price, which is 80. In this scenario, the option seller would be forced to buy 100 shares of XYZ stock at 80, but that stock is really only worth $10 per share in the market. If after the exercise, the option seller were to take those shares and sell them in the market, they would be locking in a $70 per share or a overall $7,000 loss given that there are 100 shares involved. The best case scenario for an option seller is for their option never to gain intrinsic value. For example, let's say instead of the market price going down to 10, let's say it goes up to 90. Well, at $90 per share, there's no reason why the person that purchased the option is going to exercise their right. Why would they want to exercise the right to sell at 80 when the market is trading the investment at 90? So at that point in time, the option will just expire worthless and the option seller will not need to fulfill their obligation. When this occurs, the option seller essentially was paid a premium to do nothing. Now, the premium refers to the last part of the option quote that we haven't covered, which is the $7. The premium is the value of the option on a per share basis, so that really means this option is worth $700. When this option is sold by the investor, they will receive $700 for putting themselves into the obligation and exposing themselves to the risk that's involved with this transaction. The option buyer pays the premium for the right that they gain, and the option seller receives the premium for the obligation they put themselves into. And that's the game of options. Basically, two different investors betting on where stock prices will go in the future. The premium can be further broken down into two things that we've already discussed fairly thoroughly: intrinsic value and time value. As we've learned, intrinsic value reflects the current exercise value of the option. Let's again assume the market price of the stock is at 78. And at 78, the option has $2 of intrinsic value given the fact that it allows the option buyer a better price by a factor of $2 per share. Now at this point, I'm sure there's a lot kind of moving around in your head in terms of the buys and the sells. Options are pretty tough to first understand and to master. But here's an easy way to determine if an option has intrinsic value. It's the saying, call up, put down. This is a put option, so let's focus on put down. When the market price of the underlying stock goes below the strike price, put down, a put has intrinsic value. If the market price were to go above the $80 strike price, the option would not have any intrinsic value. It doesn't have intrinsic value because there's no exercise value to the person that purchased the option. And that would be the best case scenario for the person that sold the option. Of course, at a market price of 78, the option has $2 of intrinsic value. The remaining part of the premium represents time value. Once we know the option's premium and its intrinsic value, we can do a little bit of algebra and figure out what the time value is exactly. With a premium of $7 and an intrinsic value of $2, that must mean the time value of this option is $5. Breaking down the option this way helps an investor understand what they're being paid for when they sell this option. $2 per share, or $200 overall, given that each contract covers 100 shares, is compensating the option seller for the immediate intrinsic value that they're exposing themselves to. $5 per share, or $500 overall, is paying the option seller for time, knowing that more time results in more risk of the option gaining additional intrinsic value. If this were an option with a longer expiration, we can safely assume that its premium would be higher. For example, a February 80 put would have a higher premium simply because it has more time value. Comparing the two, the January and February 80 put both have the same amount of intrinsic value when the market price is at 78, but the February 80 put would have more risk associated with it because it lasts 1 month longer. More risk will result in the option seller requiring more compensation. So let's say that the February 80 put has a premium of 9. Still assuming XYZ is at $78 per share, both the February and the January option will have $2 of intrinsic value associated with them. However, the time value of the February option would be $7, which is $2 more of time value than the January option. That's how time value works. And just so you know, premiums fluctuate in the market just like stock prices. They go up and down on a daily basis and are primarily influenced by supply and demand. The more risk an option exposes an investor to when it's sold, the more that option seller will ask to be compensated to sell that option. Now we're getting to the end of the video here, so let's go ahead and summarize everything we've gone over so far. This is a short option, which means this option was sold by the investor. Short puts result in the obligation to buy 100 shares of the underlying stock at the strike price until the option expires. The underlying stock is XYZ, the strike price is 80, and the expiration is January. And with options expiring on the third Friday of the month, this option will expire on the third Friday of January at 11:59 p.m. This $7 option premium reflects the compensation made to the investor for selling the option. Of course, that's on a per share basis. So that $7 premium really means that $700 will be paid to the investor that sells this option, and that payment is compensation for the obligation they put themselves into and all the risk that comes with that obligation.